Hello, my friends. Today is April 26th, and this is Markets Weekly. So this past week, we had a really strong rally in the S&P 500, still below the 50-day moving average, but basically we went straight up for the past few days. Looking across asset classes, we also see that the bond market well behaved. 10-year yield down to about 4.2 something. And also we see gold down a bit. So overall, it looks kind of like a mean reversion trade. So this seems to be in part driven to changes, or at least anticipated changes in policy. So today, let's talk about the anticipated changes in monetary and fiscal policy, and also some of the preliminary impacts of tariffs we're seeing on the real economy. All right, let's start first with monetary policy. So last week, we were talking about how Trump could potentially fire Jay Powell. After all, he did very memorably say this.
And I'm not happy with him. I let him know it, and if I want him out, he'll be out of there real fast, believe me.
And over the weekend, we had reporting that suggests that the Trump team really was studying ways to get rid of JP. Now, the market did not like that at all, and on Monday, we had a pretty big sell off. The day after, when asked about firing JP, Trump gave this answer.
To clarify, you have no intention of firing Jerome Powell because here, economic advisor Kevin Hassett a few days ago said that you and people in the White House were studying this idea of possibly getting before his term ends.
No.
Do you have any plans on doing that?
None whatsoever. Never did. The press runs away with things. No, I have no intention of firing him.
So basically, Jerome Powell, never heard of him. Fired him? Nah, come on, that's never said that. So he walked it back completely. Now, behind the scenes, the Wall Street Journal is reporting that Secretary of Treasury Scott Bessent, who was a former hedge fund manager, and Secretary of Commerce Howard Lutnick, who used to run an investment bank, both gave the president advice that this is not a good idea, and seems that the president has accepted this. So for the moment, Jerome Powell is going to be safe as Fed chair, at least until his term expires next May. So for the moment, no one has to worry about the loss of U.S. monetary policy independence. Everyone can worry about that next year. Now, on that topic, Kevin Walsh, who is viewed as the favorite to be Trump's new Fed chair, was also out giving speeches the past week, reminding everyone just how big of a hawk he is. So I don't know what's going to happen there, so we'll find out next year. This past week, we also had a pretty interesting speech from Governor Waller, who over the past few years has been pretty influential on monetary policy on his views of tariffs. Now, we heard from JP a little while back, and JP was really worried about tariffs having an impact on inflation expectations, whereas if inflation expectations were unanchored, that could really tie the Fed's hands. So it definitely wasn't a dovish speech. We also had data from the University of Michigan the past week on consumer inflation expectations. Again, this is only one survey, but it does suggest that inflation expectations for consumers are rising, especially among Democrats who right now expect inflation on a one-year horizon to be as high as 8%. So some people are very, very concerned about inflation. Now, Governor Waller was actually pretty dovish in his speech. Again, tariffs supposedly could potentially raise inflation and also lower growth. But Governor Waller said this.
See, I'm willing to look through whatever tariff price effects there are, and I've said that. So for me then, I'm not going to overreact to any increase in inflation that I think is attributable to the tariffs. But if I see a significant drop in the labor market, then the employment side of the mandate I think is important, and we step in. And we would have to start, I said this last week in my speech, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
So basically, he is adamant in his view that the price impact from tariffs are going to be transitory. So remember, inflation is the rate of changes in prices. So right now, the Fed's inflation target is 2%. That means, let's say, a 2% increase in prices per year. If we have a big tariffs, that means that in year one, we could have a sudden rise in the price level, but that doesn't mean that that one-time increase is going to continue to the same extent every year after, because, tariffs are not going to continue to rise. At least they're not expected to continue to rise every year. So he thinks that, yes, tariffs could potentially cause prices to jump this year, but because it's a one-time change in the price level rather than a change in the rate of change, so change in inflation, he's willing to say that that's transitory and not react to that. What would really get him to cut rates, though, is a rise in the unemployment rate. He's concerned about growth. Tariffs could be very disruptive to the economy, lead to layoffs, and uh, that in his mind would lead the Fed, well, for him to advocate for more rate cuts. Now, at the moment, the market is pricing in basically a very, very small chance of a cut in May, but a notable potential for a cut in June. I guess we'll just have to look at the data to see how things react. Now, looking at the unemployment data, again, we get weekly unemployment claims. You really can't really see any deterioration in the labor market. We hear a lot of anecdotes where companies, for example, Intel, laying off 20% of their workforce the past week, but we just don't see that in the unemployment claims data. Looking at this data, it looks like it looks pretty steady actually. So next week we're going to get the non-farm payrolls, and maybe we'll see some deterioration there, or maybe we'll have to wait a few more months before it finally shows up. Again, many people are expecting, due to Doge cuts or due to all these anecdotal reports of layoffs, that eventually we're going to see slower job growth, a spike in the unemployment rate. But right now, there's just no evidence of that. When that happens, if it happens, I think the expectation would be the Fed would become more aggressive in their cuts. So on the second policy change we've got is, of course, changes in trade policy, or at least anticipated changes in trade policy. Now, remember, during Liberation Day, President Trump put huge tariffs on China and big tariffs on the rest of the world, comically large, really. Now, the market reacted very poorly to this, especially the bond market, and I'm sure there was a flood of calls from corporate CEOs and even small business owners on this topic. So this led Trump to pause for 90 days tariffs on the rest of the world, but he kept the very large tariffs on China. So that 90-day reprieve on the rest of the world really did, I think, calm things down a bit and has led to a flurry of trade negotiations. The current plan seems to be that we're just going to have rolling negotiations for the next few weeks and see what happens. Now, usually, historically, trade deals actually take months, if not years, to finalize. So I think people who study trade really are skeptical as to what could happen in these 90 days, and I'm not really sure what the administration expects. But again, Trump continues to talk up the potential for trade deals. But the really good news in trade the past week was the potential for Trump to lower the big tariffs he has on China, which I believe are around 145%. And that is comically high, right? That's basically decoupling from China. Now, we had reports earlier in the week that Secretary Bessent gave private talk to some investors saying that, yeah, these high tariffs are unsustainable and we're going to back them down. When that leaked out, the market really liked that. And later on, it seems like Trump, in a press conference, did seem to confirm something to that extent, saying that we're going to have a deal with China one way or another. If they talk, that's great. If not, we're just kind of set tariffs at a certain level and basically do this unilaterally, with some reports suggesting that this is about maybe 50% tariff. So going down from 45% tariffs to 50. Now that's a move that made the market happy, but at the end of the day, that's still pretty high, right? Definitely much higher than before. Now, we also had an interesting speech from Secretary Bessent this past week in Washington, where he kind of sketched out where he views his ideal trade deal would be. He said this:
there is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together. This is an incredible opportunity. And I think if the Bridgewater founder Ray Dalio were to write something, he could call it a beautiful rebalancing.
So basically, Secretary Bessent is saying that looking out, zooming out in the world, China has a tremendous, tremendous goods trade surplus. They're selling too much to the world, and their own government knows that's kind of a problem and would like to transition to be a more balanced economy. Now, the US, we have the opposite problem. Our people are buying too much stuff from abroad. We have a tremendous goods trade deficit, and we want to buy less from abroad and produce more at home. So we want to balance, and we could work together to get this happen, to make this happen. So that's his ideal version of a trade deal. So I don't know if that's going to happen. From all accounts, it seems like trade negotiations with China are not going very well. Now, President Trump is telling everyone that they're talking with China all the time. But curiously, the Chinese embassy is telling everyone that, there are really no talks, and please don't say these confusing things. So it's kind of a fog of war right now. So this week I'm going to write about why that, it looks like this is not going well, and the lows in the market are not yet in at the moment. But all these potential changes in policy, of course, represent, I guess, a walk back, and it's leading to some mean reversion in the markets. So we got a very strong rally in stocks, bond market is calming down, and gold, which was trading, of course, in part due to fears of all this policy risk, also came down quite a bit. And how far this relief rally can go, who knows? These things can go for some time, but it seems like the fundamental problem really hasn't been solved yet. Now, we had Liberation Day a month ago, well, not even a month ago, a few weeks ago, and now we see some of the real impacts on the economy. So Craig Fuller, who is an expert as a company that studies logistics, is highlighting that container volume shipments from China are declining significantly. So when you have 140 some percent tariffs on China, obviously that's going to impact how much you want to buy from China, and it seems like that's leading to a lot of people to cancel imports from China, and so that's leading to a real drop in transportation from China to the U.S. So the way these things work, it takes these things, what we see in the shelves are something that's been ordered months ago. So it takes time for what happened on Liberation Day to eventually reverberate to what we see in our day-to-day lives. So given that there's been this very, very sharp drop in shipments from China, eventually I think the expectation is that in the coming weeks, maybe June, maybe July, we could actually see a notable drop in stuff from China in our stores. So that could potentially have some economic impact, whereas you go to a store, maybe what you want is not available there. A little bit like COVID, but remember, it's only between China and the U.S. Everything else seems to be okay. The 10% tariffs the U.S. has on other people seem to be manageable. Now, Governor Waller mentioned that anecdotally, it seems like what the companies are doing is, say, the supplier would shoulder a third of the cost, the importer a third of the cost, and maybe a third of the cost gets passed on to the consumer. Now, Anna Wong, who's chief economist at Bloomberg, gave a pretty interesting podcast on odd lots, suggesting that, based on what she's seeing so far, the bulk of the tariffs are being borne on the U.S. side. So there is the exporter is not reducing their prices. However, what seems to be happening is that the importer is eating the costs by lowering margins rather than passing it on to the consumer. Now, recall, this is basically what happened in 2018, 2019 during the first round of the Trump trade war. The importers, the distributors, they basically had to suffer lower margins. Now, if you look at a graph of corporate margins over the past few years, you notice that they've really shot up a lot. So it looks like they do have some margin to burn. If that's the case, so the impact going forward would be mostly in corporate profits. Now, Walmart, during some investor conferences, also seem to suggest this, whereas they seem to suggest that they wouldn't be able to pass costs to the consumer, but instead would want to take advantage of the situation and actually grab for market share. So it seems like they're going to sacrifice, at least this big company is going to sacrifice market share, profits for market share. Now, looking at earnings, of course, the big home builder Pulte is suggesting that these tariffs are going to raise home prices but on average about 1%. So that does seem to be an impact on price, but it also doesn't seem to be tremendously high. We'll have to see what happens going forward. So at the moment, it does seem like there's going to be an impact on prices, but it looks like it's going to be okay. Now, in other earnings, it seems like the uncertainty and I guess the downturn in the stock market is having an impact on things that are more, I guess, consumer discretionary, like travel. So that's something you do when you, not because you have to, but because you have some extra money and maybe you have to have a good time. Now, airlines were kind of a mixed bag. It seems like that there is some suggestion that there's going to be less discretionary air travel, and so this tariff war seems to be impacting them as well. So we're still early. We've only been a few weeks through Liberation Day, and of course, policy is in flux. But we are seeing some preliminary impacts of trade on the real economy, and overall, of course, it is not positive. We are in a period of transition, and hopefully, and we'll see what happens, we could be in a better place a year from now, or not. So anyway, so that's all I prepared for today. Thanks so much for tuning in. And again, every week is going to be exciting. Talk to you all next week.